Welcome to Investify, where we unravel the complex world of finance, making it accessible and engaging for you. Today, we're diving into a topic that affects us all: the dynamics of the market and inflation. Whether you're a seasoned investor or just getting started, understanding these concepts is crucial. So, grab a seat and let's get into it. The financial market is a roller coaster, with ups and downs being part of its very nature. Recently, we've been witnessing a correction phase. This might sound alarming, but it's actually a normal part of the market cycle. Corrections are like the market taking a deep breath before the next move. Remember, no market can go up or down forever. Now, let's talk about the big player in the room, the central bank. They've been closely monitoring inflation numbers, which are like the heartbeat of the economy. Lately, they seem pretty confident, thinking they've hit the bullseye with their policies. But here's the catch. There's a prediction that more money printing is on the horizon. And what does that mean for us? Potentially, higher global inflation. This isn't just a hunch. It's based on the staggering amounts of money that have been printed recently. Moving on to the broader picture, the global economy has been through its own twists and turns. Picture this: 6 significant shifts in just 15 months. That's a red flag for instability. The US 10-year bond yield, a key economic indicator, has dropped to 4.4%. This might sound like just a number, but it has a domino effect influencing borrowing rates and loans. But wait, there's more. Across the Pacific, Japan's monetary policy is ringing alarm bells. Why should we care? Because their policy is unsustainable. And guess what? It's having a ripple effect on the US economy. And to add more fuel to the fire, we've got high oil prices coupled with low inventories. This combo is a recipe for higher inflation and potentially stagflation. Now, stagflation is a scenario you don't want to be in. It's like being stuck between a rock and a hard place with slow growth and rising prices. So, that's the situation we're in right now. Complex, unpredictable, but fascinating. Stay with us as we delve deeper into these topics. And if you're finding this video informative so far, don't forget to hit that subscribe button. Investify is here to keep you updated on the financial world with clarity and insight. Let's shift gears and talk about a voice that carries weight in the world of finance: Jim Rogers. A seasoned investor and economic commentator, Rogers has a perspective that's worth paying attention to. He's pointing towards an interesting trend in the investment world. With prices on the rise, he predicts that fixed income assets, think bonds and the like, are going to lose their shine. Why? Because as prices go up, the fixed returns on these assets start to look less appealing. But that's not all. Rogers is also casting a spotlight on something bigger: the dollar's status as the world's reserve currency. In a world where inflation is a growing concern, the stability and reliability of the dollar are being questioned. And here's a crucial piece of the puzzle: the Federal Reserve's response to these economic changes. According to Rogers, they've been a bit slow on the uptake. In the fast-paced world of global finance, a slow response can have far-reaching consequences. Now, let's weave in another critical factor: politics. It's no secret that the economy and politics are intertwined, especially in the US. As we head into election years, there's a noticeable trend that has emerged over time. Historically, we've seen a short-term economic boost before elections. It's like a mini economic honeymoon period, where things seem to look up, at least temporarily. But here's a fascinating insight. If you look at the stock market's performance in the third year of a presidential term, there's a pattern. Almost like clockwork, the stock market tends to do well. Why is this? Well, it's all about making people happy, or at least, making them feel happy. Politicians, aware of the upcoming elections, often pull out all the stops to create a sense of economic well-being. It's a time of spending, favors, and efforts to pump up the stock market. And guess what? This year, as the US presidential election looms on the horizon, the pattern seems to be holding true. So, what does all this mean for you as an investor, or someone simply trying to understand the economy? It's a reminder that the world of finance is not just about numbers and charts. It's deeply influenced by human behavior, politics, and perceptions. Let's zoom in on the stock market, a beacon for investors and economists alike. Here's a stat that might raise your eyebrows. In 2023, the S&P 500 index, a barometer for the overall stock market, surged by approximately 18%. That's a significant leap, reflecting the market's reaction to a variety of factors, including potential rate hikes by the Federal Reserve. These hikes are a tool to combat inflation, but they also have a big impact on investment decisions. But here's an interesting historical tidbit. After elections, the stock market often sees a positive performance. It's like a post-election celebration, but in the stock market. This trend has been consistent, giving investors a glimmer of hope in times of uncertainty. However, it's essential to remember that past performance is not always indicative of future results. Speaking of the future, let's talk probabilities. The New York Fed has estimated a 56% probability of a recession by September 2024. That's more than just a coin flip. It's a significant indicator that we need to keep our eyes open and be prepared for potential economic shifts. Now, let's bring back Jim Rogers into the conversation. He's looking at the bigger picture, the economic cycles that shape our financial world. Rogers is anticipating a major downturn, not immediately, but it's on the horizon. He's reminding us of something vital. Economic cycles are inevitable. Like the seasons, the economy goes through phases of growth, peak, contraction, and trough. Rogers' perspective is a call for vigilance and strategic thinking. As we ride the waves of these cycles, understanding their nature and preparing for their impact is key. It's not about fear-mongering, but rather about being informed and prudent. As we continue to navigate through these unpredictable economic times, let's delve into some strategic investment advice, particularly from Jim Rogers. Rogers, known for his astute financial insights, advocates for investing in hard assets like commodities. Why commodities, you ask? Because in times of inflation, assets like gold, silver, and rice often become more attractive. They have intrinsic value that tends to hold up even when currencies wobble. But here's a crucial piece of advice. While commodities can be a smart investment, caution is key when it comes to individual stock picking within this sector. It's not just about throwing your money into any commodity-related stock. It's about understanding the nuances, the market dynamics, and the specific factors that drive prices in this sector. In these uncertain times, Rogers' emphasis on hard assets is like a guiding light for investors. His insights offer a pathway to creating a resilient and diversified portfolio, one that can weather the storms of economic turbulence. But there's an essential ingredient here: profound knowledge of the sector you're investing in. This is especially true when it comes to complex areas like mining companies and oil majors. The potential for gains is there, but so are the risks. Rogers' approach reminds us that investing isn't just about following trends or hunches. It's about deep research, understanding the market's rhythms, and making informed decisions. In a world where economic challenges are becoming more frequent and more complex, having a strategy that includes hard assets could be a wise move. And there you have it, our journey through the dynamic world of market trends, economic cycles, and investment strategies. We hope you found this insight into the financial world both informative and engaging. If you did, please hit the like button. And don't forget to subscribe to Investify for more content that demystifies finance and investment. We're here to help you navigate the ever-changing tides of the economy, armed with knowledge and insight. So, stay tuned, stay informed, and let's continue to explore the fascinating world of finance together. Thanks for watching, and until next time, keep investing smartly.